Hello, everyone. Good morning. Welcome to all our participants from across the Americas and from Europe and beyond. Very early good morning to those of you on the Pacific Coast, and good afternoon to those of you in the UK and Europe and beyond. My name is Jeff Passmore, and I'm very happy to welcome you to the second in our series of 8 weekly Scaling Up live webinars. The entire series of webinars is sponsored by our platinum sponsor, EcoStrat, and as most of you know, they're North America's biomass supply chain experts. But today's webinar is hosted by Munich Re, the world's largest reinsurance firm. Now, just a couple of housekeeping things. In case you're having any problems with your audio, just check your audio settings. You may need to change your speaker settings. And if you have a Bluetooth device, we recommend turning off your Bluetooth while you're on Zoom. In the unlikely event that we experience any major technical shutdown or interference, a new Zoom link will be sent to you and the meeting will resume in 5 minutes. As a registered participant, your video capabilities are going to be disabled and you're automatically muted. The webinar is being recorded and will be available to all registrants following the end of today's session. And just a reminder to the panelists who aren't speaking, please mute your microphones until it's your time to present. As far as Q&A is concerned, please click the Q&A button and type your question into the text box at the bottom. The session chair from Munich Re will receive your question and ask it on your behalf. Please don't type your questions into the chat box. We're going to only be monitoring the Q&A box for questions. And now, speaking of our session host, Munich Re, it gives me great pleasure to introduce the chair for today's webinar, Derek Griffin, Risk Management and Corporate Insurance Partner at Munich Re. Derek, over to you and your panel.
Oh, thank you very much. Thank you for the introduction, Jeff. First, I'd like to introduce the 3 panelists for today. We have Mark Riedy, partner at Kilpatrick, Townsend, and head of the Energy, Project Finance, and Clean Technology Practice. Sue Yang, Vice President at Orion Energy Partners, and Allison Larr, Vice President in the Public Finance Department at Citigroup. You can find more information on the speakers in the Scaling Up website. And as Jeff said, I would like to invite all the participants to ask questions in the Q&A box. After we do some introductions, we'll be going through some questions from each of the audience. So for myself, I'm Derek Griffin. I work in the Green Tech Solutions team of Munich Re, primarily focused on biocircular economy, business development, and technology risk analysis for the North American market. As Jeff noted, Munich Re is the largest global reinsurer, and we are committed to mitigating climate change, and we are very active in the renewable energy space. And the intention is really to diversify the group's portfolio, and of course, mitigate future climate-related losses, and really trying to enable the biocircular economy, particularly in North America and Europe. So the team I work in, Green Tech Solutions team, we offer innovative technology risk transfer solutions for renewable energy industries, including solar, wind, energy storage, and the biocircular economy. Our group offers a technology performance insurance for biocircular economy projects that transfers technology performance risk from project investors and lenders to the insurer. And the intention here is really to enable and improve project financing. So this innovative risk transfer solution improves the bankability of first-of-kind projects. We do this by unlocking new sources of capital, new debt and equity sources, but we can also potentially reduce the cost of capital. So there are many benefits to this type of project insurance for your project financing. And we look at a wide range of green or renewable technologies, including bioenergy, recycling, waste to X, a lot of pushing blue or green hydrogen production right now, carbon capture and utilization, digestion, fermentation, gasification, pyrolysis, and a wide range of other innovative first-of-kind green technologies. The technology risk transfer solution is primarily focused on technology performance issues. And so this can be related to design, engineering, scale up, even plant operations, and the insurance guarantees the product quality and quantity produced by the facility. The technology performance insurance is intended to provide protection for investors and can cover project repayment obligations, including project debt and also equity principal repayments. Another key aspect that's very valuable to project owners and investors themselves is we're really trying to provide also revenue protection, especially in the first few years of a project, is that where you have the highest risk of a technology performance issue, and that's where you'll generally need to be looking to dig into your reserves, or you potentially have to go back to the capital markets to raise more money if there are major technology issues. This technology performance insurance can really provide that revenue protection to get over those technology performance issues in the first 2 to 3 years. And we're really trying to enable successes. We want as many successes in these projects as possible, and we're really trying to enable the biocircular economy. Currently, in North America, particularly in Canada, in the US, and in Europe, we're seeing a strong trend in renewable natural gas. A lot of anaerobic digestion projects, a lot of dairy and swine projects, and we're also seeing a lot of renewable diesel and jet projects in the US and in Canada. This is largely driven by carbon credit programs, particularly the low carbon fuel standard in California. We're also seeing a big increasing interest in green hydrogen projects, fuel cells as well, carbon capture and utilization, and we're seeing a number increase in plastics and tires recycling, and another of kind of one-off innovative green technology projects. So generally technology agnostic, and we really look at any sort of green or innovative renewable project. So the Green Tech Solutions focus on the circular economy is really aligned with Munich Re's global decarbonization strategy. There's a very strong push to support decarbonization in renewable energy industries. And by the biocircular economy technology performance insurance is a big part of that as well, to really help reduce the impact of climate change. So that's a brief introduction on Munich Re and the Green Tech Solutions team. So I would now like to introduce Mark Riedy, who will provide an introduction to Kilpatrick Townsend.
Thanks, Derek, and good morning to the audience. I'm as was said by Derek, I'm a project finance partner at Kilpatrick, Townsend, and Stockton. I head up our energy and project finance team. The firm is approximately 700 lawyers, internationally focused, with offices in 4 continents. And my focus is energy, chemicals, and infrastructure of all types. And I've worked in over 65 countries around the world in my career of 45 years. And I do a lot of work with conventional and renewable fuels of all types, electricity and energy storage. And then the same with conventional and renewable chemicals and virtually every type of infrastructure project I've worked in over my career. So that's a brief introduction for me.
Thank you very much, Mark. I will now pass it to Sue Yang, who can introduce herself and her activities at Orion.
Great, thanks so much, Derek. And good morning, everyone. I'm Sue Yang. I'm a vice president on the investment team for Orion Energy Partners. We're a private credit fund that's based in New York and Houston. And we all came together from different parts of the energy and infrastructure, investing, developing, project development and operating world over the past 5 years because we saw a real gap in the North American energy landscape, defined very broadly, and a gap in the capital providers serving, in particular, the middle market companies and projects across that landscape. And that specific gap is around having a highly flexible partnership style debt for that kind of size of a firm or project and that particular stage of growth before you're able to get more institutional kind of traditional bank debt or traditional private equity. And so I joined 2 years ago from Macquarie Infrastructure and Real Assets, which many of you may be familiar with as one of the large, especially equity buyout focused strategies out there, and thought that there's a lot more interesting technologies being developed, especially in the bioeconomy, circular economy space, and wanted to be at a firm that was able to serve that space better. And so, real quick, in terms of the three things we're trying to provide and bring to the table with our type of flexible debt, and we can talk about this later as well, it's really one, around quantum of capital and really being a one-stop capital provider. It's two, around flexibility and really solving for and really bringing to the table things that we understand about the energy market and therefore can translate into more flexible terms for ramp up periods, construction, etc. And then finally, it's really being a partner at the end of the day and helping to add value for the business without diluting voting rights, control, and the share of returns that you're working for. So that's sort of what we've been aiming to do. We've done 16 deals now that are very diversified, everything from more conventional power generation, midstream, downstream infrastructure to increasingly things that are on the clean tech, alternative energy, bioeconomy space, including the world's largest PET plastic bottle-to-bottle recycler, Fuel Cell Energy, which is a publicly listed company, and Bakersfield Renewable Fuels, which we just closed here in June 2020. That was a $365 million facility we put in place for a team that is retooling a portion of an idled crude oil refinery and turning that into a renewable diesel facility. And I'm happy to speak more about that later on as well.
Thank you very much, Sue. And finally, I'd like to introduce Allison Larr, who can provide an introduction to Citigroup's activities in the biocircular economy space.
Sure, thanks, Derek. Hi, everyone. Thanks for your time. My name is Allison Larr. I'm based in New York, but I cover the full US. As I'm sure you're aware, Citi is a very large firm, and we cover the full spectrum of financial products for bioeconomy projects, but I'm going to focus on what we do in the municipal securities division. I'm a vice president in the public finance department, and in that role, I serve as an investment banker for private sector clients who can access the tax-exempt market. For those who aren't familiar, the tax-exempt market is largely for governmental borrowers in the US, but private borrowers can access that market for certain qualifying projects, including most anaerobic digestion and many gasification and pyrolysis projects. We're not technology specific. We're more worried about what the source of feedstock is, because if it comes from a solid waste product, or if there's some sort of wastewater treatment component to the project, it would likely qualify for tax-exempt debt. Well, why do we care about tax-exempt debt? Because it has a number of advantages compared to other public debt markets. The prime advantage is that the interest on tax-exempt debt is exempt from income taxes for the investor, which affects a federally subsidized borrowing rate. For example, a 35% tax rate means that the after-tax yield is equivalent to 65% of the nominal taxable yield. Therefore, tax-exempt is usually priced at 60 to 85% of similarly rated corporate debt and represents a really low cost of borrowing for borrowers relative to other debt markets that they might be able to access. Other benefits are that the market accepts non-investment grade greenfield project finance credits. It accepts non-traditional construction arrangements, and it accepts tenors of up to 30 years, as well as flexible covenants, terms, and conditions. Without going into all of our credentials, Citi is a leading underwriter of tax-exempt debt, and we have experience on several biomass projects that have been in the market recently, and we have a pipeline of other projects that we're hoping to bring to market in the next couple of months. Away from Citi, multiple other biomass projects have used the tax-exempt market to secure financing in recent years. And although it's really a US-based market, it has a number of lessons learned from projects that have accessed this market that could be applied internationally to some extent. So, while this is a US-based market, for those who have US projects in the works, or if you're interested in learning more, feel free to reach out to me afterwards, and I'd be happy to discuss in further detail. Back to you, Derek.
Okay, thank you, Allison. So thank you for the introductions, Mark, Sue, and Allison. And so again, just to remind everybody, if you do have any questions, you can ask them in the Q&A box. And please, if you have a specific person you want to ask that question to, indicate that, or if it's an open question to the entire panel. And so do any of the other panelists have any comments they want to add before we start on some questions? Okay, so I'm going to open up with a question for everybody, and something that I tried to touch on, but I think everybody's very interested in. What are the trends that are you seeing in the bioeconomy space? Because you come from very different segments, but all working in project finance. So it'd be interesting to hear, and we can start with yourself, Mark. What trends are you seeing currently?
I'm seeing a number of trends. The first trend that I'm seeing is that the main fuels that are being project financed are renewable natural gas. They're being used in fleet vehicles, short haul trucks and buses. I'm seeing renewable hydrogen, and those are in long haul trucks and buses and port operations, renewable diesel, and sustainable aviation fuel. As Sue mentioned on her recent closing, the second trend I'm seeing are petroleum product refineries converting to renewable diesel manufacturing facilities. Sue mentioned the Bakersfield refinery. There's also recent announcements by ExxonMobil, by Phillips, by Marathon, and Holly Frontier in this space. Another trend that I'm seeing is the use of biogas and renewable hydrogen in refinery and hydrocracking operations to make the refineries sustainable as they shift from hydrocarbon based gases to for the hydrocrackers. I'm also seeing the use of solar, wind, biogas, or carbon capture for sequestration or use to reduce carbon intensity scores, CI scores. And they can do it substantially, and particularly for liquid fuels. I'm also seeing an expansion trend that is developing that Jordan Solomon particularly is working on, and I've been assisting him at EcoStrat, expanding qualified opportunity zones in the United States into biomass development opportunity zones to get beyond the reach of what's there right now, which is an incentive-based equity solution. And then the last one I'm seeing, particularly for Canada, is the United States is seeing states expand their low carbon fuel standard laws. The same thing in Canada with the clean fuel standard, which will be in place in mid-2022 for liquid fuels and in mid-2023 for gaseous fuels. And with that, you'll see an expansion of these different renewable fuels in Canada, as we've been seeing through the United States with California and Oregon, and now the expansion with legislation that's in place in various other states.
Thank you, Mark. I mean, you covered a lot of the trends. It'll be interesting to see if Sue and Allison are seeing anything different, but yeah, thank you for the detailed response. Sue, how about you?
Yeah, well, I certainly agree with Mark's coverage on especially the technology supply side kind of factors. I think spot on across everything from renewable natural gas on the liquid side, renewable jet, renewable diesel. I have all seen a lot of attention, garnered a lot of attention, and the technologies themselves have developed. I think we've seen that in some of the more recent deals that we've taken a look at over the last kind of 18-month period in particular. What I'd add on to what Mark said is really around the latter point, and I'd expand on some of the demand side factors and the real pull factors that I think are also quite interesting, because the technology evolving and becoming more economic is certainly one thing. I think that now is also being coupled with the regulatory elements that Mark talked about. certainly here in the US, definitely seeing that in Canada and elsewhere in the world as well. And I think, what drives that as well? What drives companies like Exxon and the other oil majors to pay attention to this sector? Yes, it's regulatory in one part, but I think there's also end customer factors there too. There's kind of a, look, if you don't participate, you're going to lose your license to operate. If you don't participate, you may not be able to attract the type of talent that is going to, evolve the companies and produce the leading companies in this next decade here. If you don't participate, then you may get just left behind entirely. And then I think there's also other interesting factors, just to not repeat what Mark said, but to add on to that, right, that I think I'm even seeing with consumer goods companies, right? I think it says something that a lot of fashion brands even out there are really paying attention to using recycled materials. It's a lot of these consumer electronic companies are thinking about end of life. A lot of the retail electric vehicle companies are already starting to think about end of life recycling for their batteries, components, etc. And I think all of that is in response to tailwinds that are on the ground.
Yeah, thank you, Sue. And some of the areas that we're seeing as well, solar panel recycling, it's not happening yet, but in the next 10 to 15 years, that could be the next thing going to landfills, unfortunately. So we see some companies trying to get ahead of that. Same thing with batteries for energy storage, or the large scale energy storage facilities. E-waste recycling, that's obviously a big topic, especially since a lot of that stuff cannot be shipped overseas anymore. So we're seeing a lot of these alternative recycling technologies coming forward as well. And so Allison, we'll send that question to yourself.
Well, I think that you've covered many of the big trends that I've been seeing, over the past couple of years. Certainly, Sue, I definitely agree with your point that consumers are more attuned to the social impact of their wallet. And I think that that's going to be a driving trend that we're going to continue seeing, especially with, it seems like focus on the climate has been renewed recently. Your point about major companies paying more attention to this is also reflected in the deals that we see. I think a lot of our, well, maybe not a lot, but a growing number of our clients and potential clients are partnering with major companies for offtake agreements for their fuels, so that they can secure some of the revenue that they're going to be producing as a result of their projects. And Derek, you bring up the great point of e-waste, and that the pipeline of sending waste from the US or other areas of North America over to Asia is being reduced as the rest of the world is increasing their focus on environmental sustainability. So, we're seeing more and more clients come to us with projects that would use e-waste as a feedstock. So I don't know if I really have too many trends beyond what the previous three panelists mentioned, but just to underscore that we're seeing this in the, on the debt side of things as well.
Sure, and with that, so Allison, we have a specific question for yourself, and I think a lot of the questions that are coming through are focused on project finance, which is great. So Allison, in your experience, how have biocircular economy projects traditionally been financed in the US? So you mentioned your tax-exempt bond market approach.
Yeah, so until recently, that wasn't really available for these sorts of projects. Until maybe 10 years or so ago, most of these startup projects were financed away from the public debt markets. In some instances where there was a credit-worthy corporation that was developing a project and they were just putting the debt on their own balance sheet, perhaps the public debt markets would have been available to them. But mainly we had seen that the primary sources of capital were developer and other private equity, private loans, governmental grants, and loans available from federal loan programs. So this was really the bulk of where we saw the capital being sourced to develop these projects. We also saw tax equity, and that's been something that has been part of the environment recently as well. But we've seen tax equity be used as a component of capital stacks, whereby investors with the desire to lessen their tax burden contribute equity to a project in exchange for the tax credits that it can generate. And then these investors can then lessen their income tax requirements. While these historic avenues of capital are still available, in recent years, we've also seen the public debt markets open up, particularly the US tax-exempt market in certain instances, and we've also seen an increased interest from private equity investors as well.
Yeah, we're seeing, I think Sue and Mark probably talked to that comment as well. But yeah, we're seeing a lot of interest from equity, even more equity flowing into these projects than we had seen previously. Any other comments to that, Mark and Sue, in terms of project equity availability?
Project equity availability, it's been slowed down, particularly in the United States during the COVID times. But in the last month or so, people that were had stepped back, particularly large private equity companies that were trying to manage their portfolios that were in trouble because of layoffs and lack of revenue. They're starting to now reappear, and we're getting a number of term sheets again on projects. Give you an example on a large sustainable aviation fuel project that I'm doing right now. We have a major investment bank that has placed the project in front of 110 private equity players, and we had 22 NDAs signed in the first 3 or 4 days, and we now have, and this is over the last six-week period, we now have 7 term sheets in play, and so I think that portends very well for the industry on the equity side.
Great, thank you, Mark.
Yeah, and I just add on to that, generally the capital that we actually kind of compete with in these projects is private equity, not necessarily other debt available like what Allison is providing, and all because we're sort of blending it all into one facility in the form of this stretchy debt concept. But what I observe actually where there are still gaps on the project equity side are one around earlier stage, more capital intensive technologies. I think we see a lot of that in the biofuels, bioeconomy space. There was a clean tech 1.0 that had invested pretty heavily in the broad clean tech kind of space, right? Including a lot of these technologies back pre-global financial crisis times that got really burned. And I think there was a big pullback as a result of that has yet to be fully filled. I think we are seeing a lot of new equity participants who are specialized in the space and therefore better suited to invest in that world coming back in, which is great. I think we're seeing grant-making organizations come back in. I think we're seeing governmental organizations stepping back in, which is all great. But there is still a gap there. And then I think the other equity gap that we sort of see in a lot of these projects is at that development phase. So if you're looking for equity for, notice to proceed forward, easier to find that, easier to raise basically 50 million versus 5 million. Or the initial bits. And I think I see Allison nodding there too. So I think she probably sees a lot of that too. And I'll let others weigh in more.
Yeah, just to expand on that, Sue. I mean, one of the questions that we're often asked is, well, how much equity do I need before I can do a debt deal? And sadly, that answer is always like, well, it depends. But if you have it depends on how well your feedstock is accounted for and how well your offtake is accounted for as well. So that range of equity requirements could be between 20 and 40%, depending on how much risk there is in other aspects of the project. Something that I might touch on a little bit later is that we've seen some project developers try to use subordinate debt in lieu of equity, and that has had mixed success in the US to date. So that's one strategy that people have tried, but I think that getting away from a pure equity contribution can have ramifications on demand for your project from a debt debt securing perspective. And should problems occur during construction or ramp up, you don't have that larger equity base that you may need to tap into for additional capital during startup. So just a couple notes there. Sorry about that. Something happened with my Zoom. But maybe back to you, Derek.
And that kind of leads into another great question. And I'll start off with Sue here. So where do projects often fall short for yourself and Orion as an investment opportunity? I know we've talked about offtake and supply agreements. Obviously, there is the amount of equity available into a project. And I think this would be interesting to hear from each party. Really, where do projects fall short?
Yeah, absolutely. So let me maybe start with the dream project to finance. And I'm sure this is true, right, for you, Derek and Allison and others too. This is like textbook project financing 101, where you have a highly proven technology with, thousands of hours of operating data showing that they can perform to whatever minimum levels that they are presenting, right, in that particular project. 2, fully wrapped lump sum turnkey EPC contract with a third party contractor who has like $1 billion balance sheet, so very credit worthy. And then on the commercial structure side, it's buttoned up from end to end, meaning on the feedstock side, the volumes and specs are guaranteed. It's also a third party who has a solid balance sheet. On the offtake side, it's a contract that guarantees some kind of fixed volume or floor volume. There's a pricing pass-through that takes actual costs into account, not just indexed costs into account, and passes that through. And then all the permits, rights of ways, interconnections are all in place. That would be a dream. That's unlikely an Orion Energy deal. That would be probably like Allison and others who are even more institutional, and probably the bank world even, right? Like, these aren't the deals that I'll let you speak to more of that, but I think that would be like a very easily financeable project, and you'd have a lot of capital providers competing for that, especially given interest. Where things tend to fall short, because I think developers often bring us projects that they think check off on a lot of those boxes, and it's the nuances where things fall short, right? So let me point to 2 specifically, and then I'll turn it to other panelists here, because I think Allison, Mark, yourself too have a lot of perspectives on this, right? One is around, on the technology side, we often see actually a lot of binary risk around scaling up that technology. Not to reference the title of this conference and all, but there's a difference between a pilot stage project and getting to the next project that's kind of commercial scale. And since we're kind of lenders at the end of the day, and just within our investment mandate, we need to see commercial track record. And there's, we've seen in other deals too, plenty of scale up risks where things don't scale linearly from a thermodynamic perspective, et cetera, right? So that's one, around nuances in technology risk. And then I think 2 other pieces is around contracts being weaker than presented. So there's no fixed prices, there's easy termination rights on the side of the off-takers or feedstock providers, where they can terminate for convenience with just a 30-day, 60-day kind of notice period. And then finally, it's also the creditworthiness of those counterparties. We're not expecting all the counterparties to be multi-billion-dollar balance sheet types of companies, but I think if that's not the case, which often it isn't, right? Like, is there diversification in the number of providers that you have that have more of a basket than you need for the project? And is there just enough support there from those parties?
Thank you, Sue. And we see a lot of the same challenges. Especially companies will be trying to leverage insurance to go from pilot to commercial. So we see a lot of technology scaling up risk, where there may be some interest from the the equity or the debt markets, but they say if Munich Re will insure and back this technology, well, there must be something to it. So we see a lot of companies and projects coming to us, kind of trying to leap over that demo stage or that commercial demo, and that's a big challenge for us as well. Mark or Allison, anything else like normal pitfalls you see in trying to put together a program or project financing?
Well, I think on the, to mirror what each of Derek and Sue have said, the, technology risk is the big area. which I need to face with my developer clients to get Sue involved and to get Allison involved in the project. So, you know, if I was doing a government finance and I was doing it at USDA, I would need to have a pilot with its data of about 1,500 hours plus. Then I'd need to have a scale up with a demonstration unit with 120 days. And then I could step to a commercial financing, but still I'm not going to get folks' interest at commercial banks without a credit enhancement like a loan guarantee or the use of a technology insurance wrap like Derek's company at Munich Re has. And so that's how you try to ameliorate the technology risks that are out there. And where projects have fallen on their face has been where they have tried to jump from pilot directly to commercial without going through the necessary scale-up steps. And so you want to get a developer to face that earlier than later. And then there's lots of different contracting that can be brought to bear that to eliminate commercial risks. You know, like people had spoken about getting floors in contracts on the offtakes. That what I try to do is get a floor that will cover the debt service. I mean, the last thing that that a lender's going to want is somebody to fall on their face on paying their debt service timely and in full. And so that's the most important element in these offtake agreements, is to be sure that you can cover the debt service. And so you want long terms, you want fixed floors. You don't want to rely as much on the regulatory incentives if possible. And in the US, if you have to rely on one versus another, you'd rather be relying on the low carbon fuel standard, which has more certainty than you would the renewable fuel standard or the RIN. So, I mean, those are some of the commercial type of risks. You want to also be sure that your feedstock agreements are going to stand up. Not only that they're long-term, but that the feedstock will be there and it'll always be in the quality and quantity that is needed so that you can produce the amount of product. Because if you can't produce the amount of product that is required, you're not going to be able to meet your debt service. So those are a couple more risk identifications and how to try to ameliorate them.
Yeah, I think, Sue, I was kind of smiling when you were talking because we have the same dream project, but you know, that doesn't come across my desk too often. And I think that all the points that were brought up here are really just very important considerations of any project financing that's to be brought to market, whether it's an equity investor or a debt investor. And you know, I would just make one clarifying point that many institutional investors will require that firmly buttoned up project, but the municipal market actually accepts a great degree of risk. So, you know, non-traditional EPC arrangements, you know, market risk on both the feedstock and offtake side. So there is an investor base in that debt market for non-investment grade, high yield, riskier transactions. But back to you, Derek.
Yeah, that kind of leads into a question from the audience. And so in the forestry sector, it's almost impossible to obtain long-term supply agreements, feedstock supply agreements, longer than 3 years. So when you have those types of projects come across your table, how do you deal with that? You know, as an analogy, the pulp and paper industries has been successful in securing finance despite long-term feedstock agreements. So any comments in terms of, you know, these short feedstock supply agreements and, you know, why pulp and paper may have been successful where forestry has not been?
Yeah, we actually just did a deal recently that's a bit relevant to this. It's a business called Highland Pellets. So they produce woody biomass pellets for a UK power producer, right, who needs them, and they're based down in Arkansas. And here, I mean, they have some feedstock contracts, right, from local suppliers, but it's mostly mom and pops too. So, you know, you can have a minimum volume commitment from these players, but is the credit worthiness of the off-taker there, or sorry, of the counterparty there? No, not really. So how do we get comfortable with that? We did a lot of analysis in that situation on the wood basket in that region and got quite comfortable with the fact that there is, you know, multiples of supply available relative to not only our demand for this particular project, but also for sort of competing projects and those in the visible pipeline, you know, coming. And then it's also, how does pricing work, right? Because ultimately you can probably get the supply you need, but you'll have to pay up for it. And I think in this case, there's a contractual arrangement too, where we were able to get comfortable with at least recovering a decent amount of potential cost increases if supply got short.
Yeah, and I definitely agree with that. That's a strategy that we use as well. We use independent consultants just to, you know, provide that third-party opinion that there will be sufficient feedstock in the area for the duration of the debt commitment. We also like to look at the quality of relationships that the developer has in the region, because, you know, should the feedstock arrangements that they have at financial close fall away, if they have a good community, you know, it's likely that they'd be able to make some of those same arrangements with other parties. So you can't really get around the length of feedstock arrangements in certain industries, but if you do your analysis and, you know, if the surrounding area supports the project, then typically there are ways to get comfortable with non-ideal Sue and Allison dream project feedstock arrangements.
I would agree with each of Sue and Allison on that. I think that's where it becomes critical that you have a feedstock study that's done that will support the quantity in the area, and that it will be there. Another thing that is in the works is a feedstock insurance policy that is being worked on right now. And maybe a third item would be to have a relationship with a feedstock aggregator. So if there's any hiccup in the supply, that somebody who is highly skilled on sourcing feedstock and bringing it in can move quickly, and so that you don't have a loan covenant default, which would be very problematic.
Thanks, Mark. And I just want to highlight, you know, Jordan Solomon from EcoStrat will be leading a discussion later in one of the sessions, and also will be hosting a panel I believe on the last session, and talking about qualified opportunity zones and also the biomass supply chain risk standards. So, you know, you can tune in onto some of those webinars for more information on biomass supply chain. So a couple other specific questions. I have two questions kind of related to kind of the risk appetite for each group. So given the need for economies of scale and financing, what is the smallest size of project debt deals you will consider?
Yeah, so on our end, our minimum initial draw is 20 million, ideally more like 25 million USD. And our sweet spot is 50 to 100 million dollars in that debt check, which again, you know, in some instances can be 50% of the total cost of the project, could also stretch up to 90+%. We don't have hard and fast rules on percentage loan to cost or multiples of EBITDA, just looking for that credit story to be there. Yeah,
for the U.S. tax exempt market, for project financings, it's probably, you know, around $25 million. I think that projects that are closer to 50 to 75 million will garner more interest from investors because they think they'll get a pretty good allocation of the debt. But in terms of the ceiling, there's a lot of capacity in the tax exempt market right now. So we've sold biomass projects of upwards of several $100 million. So there's really a wide range there.
I think also the smaller projects, maybe a couple of strategies there. One would be to try to do the financing of a portfolio of projects so you can get up to a higher capacity if you're too small. Secondly, if you're in the United States and you're in areas of 50,000 people or less and it's a commercial technology, you could go into either the USDA 9007 program if it's fuel or power that's renewable. And you could, and if it isn't, you could go into the business and industry program. And in either of those, you can get up to $25 million in senior debt. And that can go down to a very low number. Those might be two other ways. And then the Department of Energy in their 1703 program, the Title 17, they have a facility plan where you can take smaller projects in. You could also take larger projects in, but smaller projects, and you can have them treated as multiple facilities for one project and set the money aside at a very low cost, potentially around 3% or less for the term of the offtake agreement plus any hedge agreements. And you could draw down on that amount on a negotiated period of time so that you could do project, facility by facility and still have it treated as one project finance.
Thank you, Mark. And from Munich Re, similar to Sue, we don't have hard, fast rules on minimum or maximum project size. I would say a smallest project would probably be in the $10 to $20 million range, very similar to Sue. In terms of a single project capacity, we can provide up to $100 million per project, but that does not mean that's the maximum size of the project. It could be $300-400 million. I would say very similar to what Sue and Allison were saying, that we're seeing a lot of projects come in at that $50 to $100 million range because I think there is appetite for that. Then it kind of jumps up to the $200 to $300 million range. So, we are working on and do see quite a lot of in the $50 to $100 million range as well. And so another question that kind of goes along with this is, what are the typical tenor for the debt that you would normally look at? How many years would you normally set up your debt tenor?
Maybe I'll start this time. And the tax exempt market accepts tenors of upwards of 30 years or longer, but it's really dependent on the useful life of the project. We can go out up to 120% of the useful life. We normally wouldn't go longer than 100%, and we like to have a little bit of a tail, but that's possible. I would say that there's pretty good demand from investors all across the tenor curve, but recently, given yield curve dynamics, longer term debt looks, the ability to lock in the longer term debt is advantageous in the current environment. We don't really have we can go from the short term to the long term. It's really dependent on how the developer wants to structure the debt. There would probably be demand for it.
Our tenors are definitely much shorter than that. We're generally doing 5 to 7 year facilities, and that's also driven by the fact that we're investing out of closed-ended funds, much like private equity funds are doing, so don't have as much flexibility there. And then I think mutually the expectation is generally that it'll be more like 3 to 5 years too. We're more like a intermediate bridge facility.
That's one of the issues we face when we're doing, say, a renewable natural gas project. A lot of the off-takers, particularly if they're the large refining companies, want to stay they'll come out of the box at a 3 to 5 year on the tenor. And so the trick is to get them out to a 10-year, which we've been successful in doing. And the way to do that is to get a carbon intensity score that is as low as possible. I've got them from -250 to a -515 on projects. And with that, we've been able to increase the tenor. And the other trick in there is to have a portfolio of projects. So if you can offer a portfolio of projects with a low CI score, you'll suddenly see people that had the blockers up drop the blockers, and you can start elongating the offtake agreement and get a much better financing in the process. So that's a couple of tricks to use there.
Okay, so with 10 minutes to go here, one topic I wanted to touch on is how are the strategies and products of each group really translatable to the Canada market? So Sue, you've talked about alternative debt mechanisms. Allison, obviously you've talked about tax-exempt bond deals. Mark, you've talked about opportunity zones and a number of U.S. government loan programs. You know, what can you comment on the applicability, or at least the strategies, how they could be translated to the Canada market? Mark, how about you go first?
Okay, well, the opportunity zones are a very tremendous, for lack of a better word, opportunity in the United States, in that there's 8,764 of these zones in the 50 states, District of Columbia, and the 7 territories and possessions. And if you can fall into one of those areas, you can draw money off the sidelines that otherwise wouldn't look at such a project. A lot of this money is equity, but it's a different bucket of equity. It is capital gains taxable equity that gets a deferral for up to 7 years, and then the increase in the value over a 10-year hold in the investment is 100% tax exempt. So on the deferral, you can reduce what would be a 20% for a long-term capital gain, or a 37% on a short-term capital gain, because there's also a basis step up in the deferral mechanism, and then the long-term capital gain on the 10-year hold, where you've eliminated, which would otherwise be 20%, goes in your pocket and jukes up your return. So there's $6 to $7 trillion in the U.S. sitting on the sidelines that could come into these, and there's 500 of these funds now with $75 billion. The typical money is commercial real estate, which will often be long-term capital gains at the 20%, commodity transactions, which will be short-term capital gains at 37%, or selling a business, which will often be a long-term capital gain at 20%. So this kind of a mechanism could be translated, I believe, up into Canada, and to then expand it with what Jordan Solomon and I have been doing with the biomass development zones, which you'll hear him talk about, could make it even a better use of money. And so that's one area. The other is the government programs in the U.S., particularly the ones that absorb technology risk, the 9003 program at USDA and the 1703 program at DOE. Those types of programs can be supplemental to what Sue and Allison have been talking about, that could be used up in the Canadian loan guarantee programs that are available.
Okay, thank you, Mark. And for Sue and Allison, another question as you address that, or is Orion and Citigroup actually looking to deploy capital in Canada as well? So maybe you could address that as you answer the question. So Sue, how about you go next? Thanks.
Sure. Yeah. So the short answer is yes. And we have evaluated a number of opportunities in the bioeconomy space that are Canada based. I will note, the one thing for us is that our loans are going to be sort of US dollar denominated, but I think that sort of easy enough to manage around when we're talking about Canada. Look, for us, it comes back down to the key underwriting principles. Are there any binary risks on the technology? If yes, then probably not the right stage for us. If no, then proceed from there. And then are the feedstock, can we get comfortable enough with the feedstock story, the offtake story? And I'm glad others sort of delved into this earlier. That also includes, right, how much exposure you have to regulatory credit risks. So if you've got a commercial off-taker, whether it's a corporate or otherwise too, right, taking that risk, then that's something where, if the project's in the US, we can underwrite you. If the project's in Canada, we can underwrite you. There aren't geographic boundaries, and we've got those components in place.
Thank you, Sue. Allison?
Yeah, so unfortunately, I'm not very close to Citi's Canada practice, but we do have a very large presence in the country. So I'm sure that we're working on, I know for a fact that we're working on a number of initiatives in Canada. So, there are likely opportunities that we're pursuing in the biomass space up north. But in terms of the translatability of the municipal tax exempt market to Canada, it would require, Canadian reform for there to be some sort of flexible, low borrowing costs, tax subsidized market to be established away from the U.S. But that doesn't mean that it can't happen. I think that it would just require the right policy reform environment to be in place in order for that to happen. But I think that a couple other strategies that we've seen in the U.S. and that we've discussed are technology insurance, and for certain projects, if other components of the transaction and the structure are tied up to an acceptable degree, subordinate lien debt in lieu of equity when equity is not available.
Sure, and just to follow on, kind of last question here, maybe we'll take 1 minute each. So we talked about a number of risks today: technology risk, obviously the carbon credit market risk, feedstock risks. And Mark, you kind of touched on this as well as Allison. So what new insurance policies could be useful to financing bioeconomy projects? So Allison, since you kind of just touched on that, we'll let you go here. Maybe we'll just do 1 minute each and we'll wrap up the session.
When can they be useful?
What types of insurance policies could be useful in financing bioeconomy projects?
Yeah, so I think that given the amount of technology risk that we usually see, I think that the types of insurance policies that are most advantageous are those that, as long as there's like an acceptable construction arrangement, I think that insurance that kicks in following substantial completion and can get the project through ramp up and operations is something that provides investors a lot of comfort. We have seen some policies that need a lot of project milestones in place before they're effective. So to the extent that some sort of policy could bridge that gap and be broader, I know that there are a lot of constraints in the insurance industry, but that would be, if we're putting our dreams out there, there's another dream. So I think I've cut into others' minute, so I'll leave it at that, but thank you.
Thank you, Allison. Sue, how about you go next, and we'll end with Mark.
I'd certainly echo that dream, just in line with our many shared dreams here of things we'd love to see. I think what's also challenging for us is kind of the missing gap from that construction phase to commissioning. I think a lot of the products we've seen go up to sort of commission, right? It just covers construction, or it's post-commissioning and tied to a lot of milestones, and recognize the challenge, the constraints that you also have, Derek, on your side, but that would be helpful to see.
Sure, thank you, Sue. And Mark, I know you're working on a number of different options, so maybe you could highlight those briefly. Thank you.
Well, the technology risk is something that has been spoken to, and you're right in the forefront of that, Derek. But I think the interesting cover there is that a couple things. One is the expansion of it beyond debt to equity that I know insurance companies are looking to do. Secondly is the use of a tracking account that can offer up to X amount of interest-free loan to correct a technology hiccup, which kind of backstops the insurance policy, so the insurance doesn't have to pay out for a long period of time, and that loan would outlive the insurance policy. So those are a couple new features. The other one we're working on is regulatory risk insurance, and that could be for both protecting the value of the LCFS in the United States, the RINs, and it's modeled on the international political risk policies that we've used around the world, particularly in developing countries, and also as part of that to protect against, in the carbon sequestration, is the any leakage or blowout on the carbon once it's sequestered. And these are important for the regulatory authorities to realize the full credit available in the United States, which is $50 a ton for sequestration and $35 a ton for use. But you got to protect that because the regulators want you to stand up to a liability over a period of time that there won't be a leakage of that back into the environment.
Mark, and so with that, I would like to thank all the panelists today for your participation in the very interesting discussion. I'd also like to thank Jeff Passmore for organizing Scaling Up 2020 virtual and for allowing Munich Re to host a session on enabling the biocircular economy. So Jeff, I'll pass it back to you. Thank you.
Thank you very much. Thanks a lot, Derek. And sadly, that is all the time we have for today. What a wonderful panel. And thank you, Derek, for leading the discussion and for the panelists' participation. We've obviously got a lot of lessons that can be learned from the U.S. experience. You'll notice my email address there for those of you who would like to get in touch with any of the panelists. You can certainly email me and I can provide an introduction to any of the panelists or to Derek as well. I want to thank our overall platinum sponsor, EcoStrat, and a really big thank you to today's session host, Munich Re. It's been wonderful to have Munich Re as a host, and thanks to our audience for attending. Thanks to our technical team, Jake and Eva. And please note, and by the way, Mark and actually a couple of other panelists mentioned the sustainable aviation fuel. So just take a note that next week's webinar is on sustainable aviation fuels. That'll be September 22nd, and it's co-hosted by CAFI, the Commercial Aviation Alternative Fuels Initiative, and Advanced Biofuels Canada. So this is Jeff Passmore signing off. See you next week. Bye for now.
Thank you. Bye.
Bye-bye.